Black Pearl Resources. Jag heter Robert Eriksson och jag arbetar med investerarkontakter och mediekontakter för ett antal bolag i Lundinsfären. Så jag känner igen många av er och har träffat er tidigare. Det är jätteroligt att det är så många här. Det var ett tag sedan Black Pearl var i Stockholm och visade upp sig här i maj, men innan dess var det ett tag sedan. Men vi siktar på att komma tillbaka regelbundet och låta John och Dan ge er uppdateringar av vad vi tycker är ett väldigt, väldigt spännande bolag. Och presentationen kommer vara på engelska, men det går bra att ställa frågor på svenska också om det är någon som hellre vill det, så kan jag översätta efteråt. Så att, med det, I want to leave over to John Festo, CEO of Black Pearl Resources.
Thank you, Robert. I really do appreciate the fact that all of you speak English and understand English well, and that helps me because I can't speak Swedish. And any questions or any issues you have, you can talk to Robert. You can translate if you don't feel comfortable trying to speak or ask questions in English. So thank you for coming out. We're glad to be here in Sweden talking to a lot of our shareholders. We plan to come here more often. I think I heard that message when I was here in May. Dawn and I were here for the Pareto Raw Materials Day, and we heard that you want updates more often. So we're going to try to make it to Sweden as often as we can. I have a presentation here, and I think the format, Robert, is going to be we're going to take questions afterwards.
Yes.
Okay, so I'll run through the presentation now, and you can take notes, or you can take note of whatever questions you may have, and we can refer back to the presentation afterwards. When I talk about the company, especially on this page, what I focus on is that the market cap, or the number of shares times our share price, is about $600 or $700 million. Swedish kroner is, I think it's the conversion 6.4, 6.7 to convert to Swedish kroner, but it's about $600 or $700 million. And the potential value in the company is $5 billion. So there's a significant amount of value. And I know a lot of you follow the stock price and what it trades at. I look at what we're doing. I look at the activities that we are doing every month and the milestones that we're meeting, and I look at the value. And I look over the last 5-6 years, the things that we've done and the value that we've created. I think that's more important. And I think that there's $5 billion worth of value, and slowly we're unlocking it over time with all three of our core projects at Blackrod, Onion, and Mooney. We have three core areas, all heavy oil and oil sands. The key considerations of the company: we're currently producing about 9,000 barrels a day. This year, our average production is going to be between 9,000 and 9,500 for this year. The revenue, or the cash flow, after all expenses, is going to be between $80 and $100 million. Right now, we're receiving very good prices. And I think some of you read the paper and see how WTI and Brent has been decreasing. For Black Pearl and for heavy producers within Canada, the price has actually been going up. And that's because the differential between WTI and the heavy oil price has been narrowing faster than WTI has been declining. So we are getting a very good price in Canada for our heavy oil. I think out of the last 6 years, this might be the highest average price we've received so far. Again, about management, that's very important when we talk about the company. The team's been together 20 years. This is our third heavy oil sands company. This is the first time working with the Lundins in building the company. We own 10% of the company. The Lundins own about 15%, and there's another large fund in Toronto that owns 15 to 16%. This large fund is Burgundy Asset Management. Why they bought into Black Pearl is because of the management. We met them before in our previous company, worked well with them, made them a lot of money, they were happy with us. Lucas Lundin and the Lundin family have invested in Black Pearl because they like Blackrod. They like a large elephant-sized oil resource that's attractive around the world. That's what they like about what we have in Black Pearl. And for the management team, we like all the assets. We think they're competitive, very good assets within Canada. So that's what attracted us to the company. We've always had a strong financial position. We currently have no debt. We have a $150 million line of credit in Canada. Although we have no debt, we're going to be building the other half, well, not the other half, but we're going to be building our first phase of Onion Lake, and we're going to be spending a lot of money over the next 6 months. And so we're going to tap into that line over the next 6 months. And so we'll use debt for the first time in the company's history. And we need to. We can't do everything just raising equity. That dilutes us too much. So we have to use a cheaper cost of capital by taking on some debt, but not so much debt that it puts the company in jeopardy. And again, the last thing that, about the company, what really attracts us to heavy oil and oil sands is the large resource base. In our first company, we grew the company to 25,000 barrels a day and had the potential for 60 or 70,000 barrels a day. And in our second company, we grew it to 15,000 barrels a day and had the potential for 40,000. And with this company, we're at 9,000 or 10,000 barrels a day, and we have the potential for over 100. And when I say we grew it to that point and had potential, at that point we had sold the company. In our previous two instances, we had sold either the company in pieces or sold the company completely. And so we always made lots of money for our shareholders. We always built value over time and both grew production and grew value in the company. Let me recap the last 5 years and where the company is going in the next 5+ years. We grew production from 5,000 roughly to 10,000 barrels a day over the last 5 years. We developed this grew the cash flow so we could tackle bigger projects. We were able to tackle Mooney. We've spent more than $150 million at Mooney over the last 5 years, and we've laid the foundation for financing these bigger projects. We also funded pilots, both at Blackrod, at Mooney, and at Onion Lake. Successful pilots that gave us the confidence to go forward with commercial projects. Now the next stage of growth, we have done primary at Onion and our polymer flood. The next stage of growth for us is our Onion Lake thermal and our Blackrod thermal. And that's going to take us, from where we are right now. 2 phases of Onion Lake take us from 10,000 barrels a day to 20,000 barrels a day, and then Blackrod beyond that. Now this slide is an important slide for us because this is our operating philosophy. This is why we've been successful in the past. Identify, validate, commercialize. What I mean by that is our skill is at identifying good resource, identifying places where we can make heavy oil and oil sands work. We're better at that than most companies. But despite that, we still have to validate. We still have to look for analog, pilot, understand what we have, drill up the resource, and then we commercialize. In our history, we are 15 for 15. We've been successful in all of our projects in heavy oil and oil sands, and it's because we don't skip that validation phase. We've seen lots of examples in Canada of companies that have done that and have failed because they didn't have the right technical expertise, they didn't have the right pilot information, or the project wasn't very good to begin with. But they went ahead and commercialized it. And also they took on too much debt. And so as soon as their project was not working at 100%, they put the company in financial peril. So there's 2 companies right now in Canada that can't pay off their loans, and so their equity is going to get wiped out. What I'm going to do now is talk about the individual properties and talk about where they are and give you an update on that. Then after that, I'm going to turn it over to Don, and he's going to talk about the financial aspects of the company. Let me start with Onion Lake. Over the last few years, Onion Lake has been a great property for us. We've drilled about 300 wells there. Production peaked at about 7,000 barrels a day. It helped us fund our pilot at Blackrod. It helped us fund Mooney. Right now, we're about 4,000 barrels a day. We continue to drill wells there. They're not very expensive. The wells pay out quickly, and they last about 6 years. So it's good short-term production to help us finance our other projects. Within Onion Lake, there's an area, it's outlined in black on the map, and it's an area with thicker pay. And because it has thicker pay, it's more thermally efficient. So we can inject steam into the reservoir, and it doesn't lose a lot of heat to the rock above and below. So it's between 10 and 25 meters thick. And so this is where we had a pilot there that worked quite well, and that's the area we're going to develop with our SAGD process, with our steam-assisted gravity drainage. You can see on the map, Onion Lake is in the top left, and there's 6 other projects on the map. This area on the map is 60 kilometers by 100 kilometers. All the projects in that area have worked very well. Some of them have been around 25 years. Various technologies, 2 or 3 different kinds of technologies, where they use steam to get oil out, vertical wells, horizontal wells, steam drive, SAGD, all different kinds. And they've all worked very well because the sands in this area of Saskatchewan are very prolific. They're very porous, and there's lots of oil in place. We can produce a well in our lands with just a pump in the ground, cold, and still get 100 barrels a day. So we think putting steam in the ground will enhance the recovery from 8% all the way to 70%. All these other projects have been very successful. We use these 2 projects as analogs. The one on your right is a project that's been around 25 years and has done very well. In a small area of land, they recovered 27 million barrels. It's still producing. It's lasted much longer than they ever thought, and it's worked quite well. And that was using a technology around 25 years ago. On the left-hand side, that's a more recent project that Husky has built. The project came in on time, on budget. It met and actually exceeded the production forecast. They built it for 8,000 barrels a day. It came in, it peaked at 12,000 barrels a day. The steam oil ratio is under 2. It's showing characteristics of one of the best projects in industry, done very well. We visited that project and used the same plant design. So we use the same manufacturer and plant design for our own project. We use these as analogs both from the operations and from the actual results that we're getting, and to understand what techniques are successful in oil sands or in the heavy oil areas in Saskatchewan. We are going to use a modified sampling process for Onion Lake. That means some of the areas will have vertical wells injecting steam and horizontal wells as producers. Typical SAGD is 2 horizontal wells, and an injector on top of the producer, one injecting steam and the bottom one producing. That's what we're going to use at Blackrod. Here we're going to use that technique and vertical injectors for steam, just because we already have vertical wells there, and it'll allow us to capture more of the oil in that area. Our first phase is 6,000 barrels a day. It's going to cost $210 million. We've drilled 7 of the producers. I believe we're going to have 13 in total now. 13 horizontal producers, 19 new vertical wells. We already have 16 existing ones. The infrastructure in the area is very good. We already produce 4,000 barrels a day from that area. There's lots of pipelines and rail terminals nearby. So the infrastructure of people, gas, electricity, roads, all those things are right nearby, so we can keep the costs down. So it's a very economic project. We think the projects that I showed you on this map, the projects in that area are some of the best, most economic projects in Western Canada. So right now in Western Canada, there's over 1 million barrels being produced using steam. And the 50,000 barrels a day in this area are some of the most economic, for all those reasons I talked about. Oil's better quality, better production rates, and the infrastructure costs and the building costs are much less. One more thing about the project. When we talk about Blackrod and Onion Lake, when we talk about having 12,000 barrels a day, that's 12,000 barrels a day for 25 years. We have enough reserve to back that up. So what we're going to do is build that plant that you see, and then phase 2 is going to be another 6,000 barrels a day, a plant right next to it. We're going to drill all those wells, and we're going to keep on drilling wells to keep the plant full. The plant is the most expensive part of the process, and we'll drill wells and pads to keep that plant full for the full 25 years. And on that map you see there, that's enough reserve to keep it full for 25 years. The next project I'm going to talk about is our Mooney project. We've been producing there on polymer flood now for 3 years. It's worked well. The key to unlocking extra recovery here, the key to unlocking the potential has been an ASP flood, or an alkali surfactant polymer flood, also known as a chemical flood. We use different techniques to get more oil out of the ground. If we just produce this well with a pump, or produce this reservoir with a pump, all we get is about 6 or 7% recovery, not very much. Same at Onion Lake, about 8% recovery. So we have to do other things to get more oil out of the ground. Typically, with light oil pools, they use water floods to get more oil out. And you put water down to repressurize the reservoir and to push the oil towards the producer. That doesn't work in heavy oil. Here we're using polymer. We are making the water more viscous using a polyacrylamide, and we're putting in surfactant, which washes the rock, and some hydroxide, some sodium hydroxide, which is the alkali, which reacts with the oil to wash more oil off the rock. So the recoveries will be up to 30 to 35%. The pilot worked very well on our phase 1 area, and you can see from the graph that the response has been quite good. This is the response from phase 1. These are our phase 2 wells that we have drilled. We should see very minimal declines, slow declines from phase 1. And once we put polymer into phase 2, again, we'll see it, the peak will be a little higher and the declines will be slower. So really, the benefit you gain from a polymer flood is repressurizing the reservoir and pushing more heavy oil towards the producer. This is what the pool looks like. Those are vertical well, or those are horizontal wells you see. That's what the black lines are. You can see phase 1, phase 2, and phase 3. We've commercialized phase 1. We have all the facilities and equipment and pipelines and roads, and that's working well. We've drilled all the wells in phase 2, and we're going to initiate polymer flood there within 6 months. We'll probably do it in stages. The lands to the east will do those last, and we'll stage the development to the west. We also have phase 3 where we drilled wells there, and they're producing right now, and we'll drill more wells next year in phase 3 and put that in polymer flood in 2016. So this project's been commercialized. It's going to be 4,000 to 6,000 barrels a day, depending on how aggressive we get developing more of the pool. Just for scale, that pool size is about 3 kilometers by 10 kilometers. So Mooney is going to be a long-term, low-decline project for us. So our base 10,000 barrels a day, about 4,000 comes from Mooney right now. That'll be increasing over time between 4,000 and 6,000. Onion Lake primary is about 4,000 right now. That'll be declining over time. And our John Lake should stay flat at around 1,000 barrels a day. So that's our base of production of about 9,000 barrels a day. Our growth comes from our thermal projects at Onion and Blackrod. Now I'm going to talk about Blackrod. That's our largest project, potential of 80,000 barrels a day. In total, we've spent about $140 million on this project over the life of the project. Just to give you some sense of the numbers, in the last 6 years, we've done equity raises of about $200 million, and we've had cash flow of about $400 million. And $140 million went to this project here, Blackrod, and the rest went to Mooney and to Onion Lake. We also invested a lot of long-term capital at Mooney for our facilities there. So not all of our wells, not all of our capital went towards drilling wells. Drilling wells is very quick and simple growth. You drill wells, you get more production. We invested a lot of our capital over time in longer-term projects like Blackrod, where we spent $140 million for land, drilling wells, and our pilot. We've drilled over 40 wells there now, and that's what gives us the confidence that the oil is there. We understand the geology quite well. The reservoir is quite consistent and quite homogeneous. Again, when we talk about 80,000 barrels a day, that's a 25-year project life. We own 100% of the project. And let's talk about the pilot results. The first pilot well pair had very similar results to this for the first 10 or 12 months. But as we were operating that first pilot, we realized there were some issues that we hadn't addressed. There's some things that we did wrong. We had to change our steaming strategy. We realized that wasn't quite optimal. we had a pump that was pumping the oil out of the ground that wasn't quite optimal, and we had a completion, or we had the pipes that we had in the ground to produce the oil wasn't the right engineering design. So we learned from that and put in our second well pair. And again, the results for the first 12 months are very similar, but we're not seeing any of the problems that we saw for the first well pair. So we have an engineering solution here. We don't need these kinds of engineering solutions at Onion Lake. And the reason is, Onion Lake's a much more robust reservoir. More oil, more higher saturation, better permeability, all the right, better technical aspects than at Blackrod. The advantage Blackrod has is it's very large and consistent, very low risk. So we figured out the engineering solution to Blackrod, and we can develop the whole project now with the information from the second well pair. We update the results from our second well pair on our website every month, and we should have the next set of results up in a couple weeks for August. Oh, that's right. Yes, our September results, I'm sorry, will be up in another couple weeks, and it's doing quite well. We're very pleased with the results. What we anticipate coming from the second well pair is a peak rate of 500 to 600 barrels a day and a steam oil ratio between 3 and 3.5. And it's nearly there now after 5 months. So another 6 months, we think we should be at those peak rates. I'll mention something else about innovations and other things happening within SAGD. There's lots of other things that are happening in terms of enhancing the productivity. Things like gas co-injection, wedge wells, other technology, other innovations. We're going to implement those. Those have been proven. Industries work with them. They're simple innovations that you can use to enhance recovery. What we're doing here is making sure that the SAGD steam process works within our reservoir. And we'll add those innovations afterwards when we have a commercial project. This is what our commercial project should look like. The red is phase 1, 20,000 barrels a day. Our plant is over here. We also have some other lands that we bought to the south, and they probably have 10 to 15,000 barrels a day. That wasn't part of our original commercial application. We're not as far advanced on those lands, but that's more potential. And there's also these lands right here beside us that have potential. They're not owned by us, but the developer of this property will eventually buy all of this and develop all of it. So if we're still around in 10 or 15 years, we'll probably have amalgamated that. And that's the beauty of this project, is it's one large project and it's one big development. And that's very attractive for companies like ourselves and companies like Exxon, Total, Statoil, international companies. This is what attracts them to Canada and the oil sands, these kinds of large projects. We plan to develop the project in phases, and what we anticipate is a first phase of about 20,000 barrels a day, then subsequent phases of 30,000 barrels a day after that. That gives us the best economy of scale. If you build it too large, you have difficulty managing the project. If you build it too small, you don't gain any economies of scale. If we had to, so we're doing Onion Lake now. In the next 4 years, we'll be doing phase 1 and phase 2 of Onion Lake. We will get to Blackrod, but to accelerate that project, we may look for a joint venture partner. So that will help us accelerate this project, because if it's too far out, there's not enough value to the company. If we have to do it ourselves after phase 1 and 2 of Onion Lake, we'll likely build a smaller phase 1, something that we can finance ourselves or do within our current capacity. So for example, in 4 or 5 years, we'll be producing about 20,000 barrels a day, cash flow of $200 million per year. Phase 1, if it's 10,000 barrels a day, will be about $500 million. So this gives you some idea of what our plans are if we do it ourselves. And if we joint venture it, we'll likely not have to spend any money for our share of the capital on phase 1. Somebody else will come in and carry us for that part, for our working interest in the property. That concludes my part of the presentation for now, and that's a property update. I'm going to turn it over to Don Cook, and he's going to talk to you about our financial situation.
This next slide just outlines some of our thoughts on financing Black Pearl. Certainly up to this point we've financed it very conservatively, as John indicated earlier, with no debt in the company and haven't had any. Since we've been here, we've financed it through equity issues and cash flow. And that's very similar to our prior company. The prior company, we started with zero production, financed it with cash flow and equity issues. We got to a point where it was producing about 15,000 barrels a day, and we had the same financing decision that we have at Black Pearl. We had a thermal project to finance. And in that instance, we did a combination of issuing equity and debt, and you'll see we've used the same structure to finance Black Pearl. Ultimately, we're aiming for a debt to EBITDA of between 1 and 1.5 times, which we think is quite manageable. You'll see, if you look at some of the other oil sands companies, they've used substantially more debt, and unfortunately have gotten themselves into financial difficulty, and we're certainly trying to avoid that. We understand equity issues are dilutive, but we also don't want shareholders to lose the company, as what's going to happen, unfortunately, with some of these other oil sands companies that just took on too much leverage. So in terms of financing our two big projects, Onion Lake Thermal, what we did is in March, we did an $88 million equity issue, and we expanded our credit facility to $150 million. So the combination of those two will fund the first phase, 6,000 barrel a day phase at Onion Lake. The second phase will be somewhat self-financing, because once we put the first phase on, that generates additional cash flow of $60 to $70 million a year. But in addition to that, our capacity, our bank credit capacity goes up, because our banks fund based on proved producing reserves. And at that point, phase one will be proved producing. And so they'll give us credit for that. So we think Onion Lake is essentially financed at this stage. And you'll see even at using debt for that first phase, our debt to EBITDA is still in that 1.5 times range, which is our target area. So we're quite comfortable using our credit facility to build Onion Lake. Blackrod, as John indicated, at this stage we do not have the financial capacity to tackle it. We think once both phases of Onion are on production, we will be able to tackle it ourselves. But we are going to pursue looking for a joint venture partner to try to accelerate that development. We've not been terribly active on the joint venture front at this stage. We've had inbound inquiries, and we are talking to those groups. But what we have found is regulatory approval for Blackrod is a big risk in a number of these joint venture partners' view. And so we've been somewhat passive until we get regulatory approval for Blackrod, and then we'll become much more aggressive in looking for a partner for that project. And in terms of that regulatory approval, we think we're probably 3 to 6 months away. There's really two legs to the approval. There's an environmental approval and there's a technical approval. We have environmental approval for the project, which is certainly the more onerous of the two legs of regulatory approval. We are working on technical approval. There are three, what the lingo they use with the Alberta government is statements of concern, objections to the project. 2 have been filed by First Nations, and they are not specific to our project. They just object to all oil sands projects. And the third one is has been filed by an adjoining operator. I'll just see if I can go back. They are objecting to the location of the central facility. They're asking us to move that facility to a different location because they think it'll affect development of their project. And so we are working with that group right now to resolve that difference. So we don't know the exact timing, but we think that regulatory approval will be in the next 3 to 6 months. This is our 2014 guidance. A lot of numbers there. The 2 key ones, I think, are capital expenditures, close to $300 million this year. The bulk of it will be spent on the Onion Lake Thermal Project. Over 70% of the total capital budget will be at Onion. And the debt, as we indicated, we haven't used the facility yet, but we're going to. It will happen in the 4th quarter. And I think the year-end debt will peak out at between $130 and $135 million. We haven't provided guidance for 2015 yet. That will likely be in our November press release. When we press release 3rd quarter results, we generally give an outlook for 2015 in that press release. Heavy oil differentials. We do produce heavy oil, so we do not get the same price as a light oil producer who gets a WTI price or a Brent price. We get a discount to that price. That price typically has been volatile. That differential between light and heavy has been very wide. As you'll see in 2013, it was at times up to 40%. 2014, it has been, the volatility is much less, and that differential is certainly a lot narrower than in the past. And the reason for that has really been the expansion of rail transportation. The issue, I'm sure most of you are familiar with the Keystone Pipeline and the trying to get approval for that. And what's happened is it gets bottlenecked in the Midwest U.S. It cannot reach the Gulf Coast by pipeline, all of the production, and therefore refiners will discount the price to us. So in the interim, what producers have done is put oil on rail, and it's really just exploded in terms of the expansion of rail cars. I think 2 years ago, Canada probably transported about 30,000 barrels a day by rail. This year, I think the number they're saying is about 130,000 barrels a day by rail. And in a couple more years, they're saying that number will be 700,000. So it has provided a very good short-term solution for getting oil to the Gulf Coast, which is what we need to get a world price for heavy oil. Because we compete with the Mexican and Venezuelan crudes that come to the U.S. Gulf Coast. And so we're happy if we can get the world price for heavy oil. And that's not to say we do need more pipeline capacity. There are, in addition to Keystone, 4 other pipeline proposals, 2 that go to the west coast of Canada, 2 to the east coast of Canada, all of which are going to face some form of opposition right now. But ultimately, we're going to need some of those pipelines built to move the increasing volumes out of Canada. But as I say, rail has turned out to be an excellent short-term solution, and I don't think it's going to be just a short-term solution. I think it will be permanent because it provides a lot more flexibility. And as you'll see, we rail about half of our production now, and that number may even go up because when the Onion Lake thermal production comes on stream, there is a very good chance that we will rail that production. There is a large rail facility being built by Shell about 30 miles from our Onion Lake project. We are talking to them. So I think there's a very good likelihood that we will rail that production as well. We've not been big hedgers of our oil price in the past. And that's really because of our financial structure. We've had no debt in the company. And our capital program, we can stop and start it pretty easily. When prices are high, we'll accelerate. Prices are lower, we'll pull back. Now that we've transitioned to the thermal projects, though, we're not able to do that. Once you get started, difficult to pull back on construction. And so we are starting to hedge some of that production. We've hedged 4,000 barrels a day to the end of the year, and we have started hedging both the first quarter and the second quarter of 2015. Not as easy to hedge heavies as light oils, the WTIs and Brents, so you have to pick your timing as to when you put those hedges in place. But I think we'll continue to hedge, certainly during the construction phase on these projects. This slide looks at our valuation of our share price to our reserves. John indicated right at the beginning of the presentation that we have the potential of over $5 billion of value, which translates to over $12 a share. Our current price is in that $2 range. So we are at trading at a huge discount to that potential value. A couple of reasons for that. I think the biggest reason right now is the oil sands sector is not in favor right now. John alluded to it earlier that there's been a number of oil sands producers who have built projects and they have underperformed, and investors have been hurt by that, and so they've left the sector. And and unfortunately, we are lumped into that group. Uh, But I want to point out there's a big difference between that group and what we're doing. In all three of those instances, they did not pilot their projects. That slide where John indicated identify, validate, commercialize. You know, in those three cases, they went straight from identify to commercialize. And as John indicated, we just view the validation stage as a critical step in learning the reservoir before you commit big dollars. Nevertheless, we are lumped in with that group, and so I think investors are kind of in a show me stage at this point. They're saying we won't recognize that value until you build it and put it on production and it produces at the levels that you expected. And I think the second reason that there's this disconnect between what we think the value of our properties are and the current share prices, certainly in North America, there is certainly an inclination for investors to look for dividend stocks right now and stocks with growth. And some of those stocks, you're probably familiar with companies that are in the oil shales where they can show steep production increases relatively quickly. Our growth is going to be there. It's just going to be more measured because of the long construction timelines to put these projects on. So at the current share price, the market is giving us no value for our Black Rod project and very little value for our Onion Lake thermal project. So we certainly think that as we build those projects, put them on production, that the market will start to recognize more of that value in our share price. I'm going to turn the mic back over to John for some closing comments.
Thank you, Don. One of the things that we hear when Don and I go to London or New York or Toronto is that junior oil sands companies have done poorly, and we think it's a very risky investment. And so we put this page in our presentation so to point out the differences, what we have done, and what our track record means. You know, we are a successful management team that has performed well in the past. We have brought on projects that make sense, that work, that are technically viable. We are currently producing. A lot of the other oil sands companies brought on projects, they had no current production, and they raised all their money using debt, and so that got them into trouble. As Don mentioned, a lot of them didn't pilot their projects. So we try to point out these differences. Each of our core areas is producing. We have been producing. We have pilots on them. We have regulatory approval from them. There's no real problems getting the regulatory approval. So all these things we like to point out that we've done, we've accomplished, that a lot of the other failures in industry haven't done. And there will be some more problems. You will, if you read the business section of the Canadian newspapers, you'll see some more projects that are coming on that will have more problems. So that's not over yet. And that's why we're going to keep on pointing towards our pilot results and keep on pointing towards our Mooney, which we've commercialized and is working, and Onion Lake, which in a year will be injecting steam in the ground, and after that we'll be getting production. So we'll keep on meeting these milestones and prove that we are doing what we said we would do. And speaking of what's going to be happening over the next 12 to 18 months, these are the key milestones. 3 to 6 months, we should get regulatory approval for Black Rod for our first 20,000 barrels a day, and environmental approval for the full 80,000 barrels a day. Don mentioned a couple of statements of concern. We don't see those as material. They're more nuisance type concerns. We may make some development financing decisions for Blackrod if we find a suitable joint venture partner. That may or may not happen. Blackrod is too valuable part of the company to do a bad joint venture deal. We're also going to expand our ASP flood at Mooney into phase 2. And first oil from we're going to get phase 1 built, steam in the ground. We'll start getting production by this time next year, and peak production in a year and a half from now. A year and a half, 2 years from now. That'll put us into middle of 16. So those are the milestones coming up for the company. And with that, we've made you listen for almost 45 minutes now, and so I think it's time to take some of your questions. So at this point, we'll turn it over to any questions you may have.
Några frågor? Här kommer första frågan.
You mentioned that depending on how aggressive we get.
Yeah, absolut.
Or I can repeat the questions too. Or, okay.
Microphone.
You mentioned that depending on how aggressive you get the movie, and maybe on the lake too, that decide. I mean, what are your decision points? What make you be more aggressive or less?
That man right there, he holds the purse string. So he says, if he's going to watch very carefully to make sure we have enough money. And we're going to be spending a lot of money this quarter. This year is going to be the biggest year for spending for the company, almost $300 million. And so we have to be careful that we don't go beyond our bank line. And so that's really what it is. And we look every quarter at our bank line to make sure that we have enough, we look every quarter at our cash flow to make sure we have enough money to do all the drilling that we're going to do. And especially for the next 2 or 3 quarters as we're building Onion Lake, we're going to watch that very carefully. And if we have extra capital, we'll drill some wells and be more aggressive with moving. You have some more questions?
I have one more question. What in your mind with the new technologies that you talked about that are available already? How much will it add?
People oftentimes talk about technology and new technology and how that's going to improve things. I really believe you have to start with good rock. And that's always been how we looked at companies and opportunities. And we've had many opportunities offered to us in terms of companies or opportunities and properties to work with. And we always start with, does it have good rock? Is it comparable to what the big companies have, to the successful companies? And that's how we start. And so we believe that the properties that we have those characteristics. We've proved it with the pilots. The innovations will make them better. So with our first company, we had a couple of properties that worked quite well. And over time, as we've seen other companies operate those properties after we sold them, they tried innovations and they did various things and made them even better. And so, yes, the innovations are good, they'll work, but you have to start with good properties. And so the innovations are things like wedge wells. You have your producing horizontal wells, and you put wells in between them to capture some of that stray heat. You inject steam into the reservoir. It also helps to inject some natural gas, and it makes the steam travel better and build a better steam chamber. At the end of the life of these wells, you put in non-condensable gas. And so there's all these things that people are doing, but you have to start with a good project. And people try to stand up here oftentimes and baffle investors by saying, oh, we have all this wonderful technology. You have to start with good projects. That is the core of any good company.
Då har vi en fråga till här.
John, I would like you to speculate a little bit with the question, if your fields, the 3 fields, were owned by, let's say, Suncor, how much would the value be in Suncor of these 3 fields?
That's a very good question. And if Suncor owned our properties, they would be able to realize the value that we see there. And what I mean by that is, Don showed you the slide of our current share price, and the value from our properties is $12 a share. Well, we can't get there that easily with our current financial structure. We don't have the cash flow, we don't have, we could take on a lot of debt, but that would be a problem. We could issue a lot more shares, but that would be a problem with dilution. So the advantage that Suncor has is it has the financial capacity to take our properties and realize that $12 a share, and that's what they would do. We sold our previous company to Shell, and everything that we had within the company, there was no issue of when they could do it and how. It was just a matter of getting it done. So they took all of our properties and developed all of them. So that's the advantage they have. There is it's almost a financial arbitrage. They can realize value, whereas small companies can't. But that's how companies like Statoil and Exxon have grown, by buying successful companies that have good properties that they apply capital to.
So would it be fair to say that if Suncor owned these fields, these properties, the market cap would be 5 billion higher in Suncor? I mean, very hypothetical, but we can play with it.
And what that depends on is if they get recognized for that value. So right now, Suncor is producing about 300,000 plus barrels a day, and they have potential for many years. They have a mine, they have a lot of things going right now. And sometimes the market doesn't pay for their future potential either, because it's too far out, or it's not recognized. So, first of all, Suncor wouldn't pay $5 billion for it because they want to make some profit for themselves. So that $5 billion is based on a 10% rate of return, or a 10% discount rate. So they would say, I want to capture some of that profit for my shareholders. I will pay you something less than $12 and capture some of that profit, and also because the market, or it won't be reflected in my share price. And so that's how they will, but eventually it will. Eventually they will develop those properties. So they buy it from us, I'll throw out a number, $2.5 billion. They keep the other $2.5 billion for themselves and eventually develop it, and that's the gain in value for their shareholders.
Thank you very much.
Så hade vi en fråga till här uppe, tror jag.
If you take BlackRock and all the approvals is given, the first phase would be 800 million. How long would it take from putting the start button and spending those 800 million before you have production?
The timeline would be about 2.5 years. So it would take 6 months of design work and another 2 years of building the project. So 2.5 years. What's interesting is what we're learning from building Onion Lake, we may apply to building Blackrod. The manufacturer that's building our plant right now is building 2 more of these very same plants for 2 other operators, and one of them is in Alberta, so it's doing an Alberta-based plant with water recycling. And so they're going to build our phase 2. They're getting very good at doing this. One of the other issues that other oil sands operators have had, and you probably can read about this, the mines have been built over budget. They've had problems here, but those are massive projects. But some of the oil sands projects have had some problems in the past. What we're learning by building Onion Lake is going to help us. So it may be less than 2.5 years. And we may have some certainty as to what it's going to cost us. The manufacturer of our steam and oil plant guaranteed us a price. They said, we'll build it for this price, because they're so confident. They built 3 of them for Husky, building 1 for us, and 2 more for other operators. So this is one of the innovations that I'm excited about. And we think we can build these a little sooner, a little better, without the engineering lead time. I mentioned that it would take 6 months of engineering and 2 years to build. We could cut that down too, because this is becoming a more modular, a better process, like building cars. They don't redesign a car every time they build one. They take the same design and build it again and again. So 2.5 years, but I'm very excited about being able to cut down on the cost and timing of that because of the experience we're gaining building Onion Lake.
Så fanns det några fler frågor från församlingen här? Det fanns en fråga till här.
When you get the regulatory approval for Black Road, and how will that change the amount of barrels that are probable and proven, and how will that affect the NAV value, do you think, for the company as a whole?
There is none, right, Don? There's no, it's not a condition of any barrels that we have.
Okay.
So that's not one of, so they're called contingent resource,
Yeah.
but they're not, it's not dependent on approvals right now, so for any of those barrels.
Right.
Sådär. Ingen
A couple of years
ytterligare...
ago, we moved some of those barrels from contingent resource into reserves because, at Onion Lake especially, because we got regulatory approval and we were moving forward. So that is one of the milestones for moving reserves from resource to reserves to proven producing, so to get it more recognized and less risk. But that is one of the steps in the process.
So does that mean that if you move forward with Blackrod, if you have the money for it, that would move the
Yes,
company,
we would have it moved from proven undeveloped to proven producing, once we built it and once it was producing. So what you'll see next year, once we have Onion Lake built and producing, it will go from proven undeveloped to proven producing. And that's a category that the banks recognize. That's why it's important too. So they recognize that as a more valuable piece of the company that they can loan, increase your loan against.
So if no further questions, I would like to thank you all for coming here, and we will be back next year, I guess, and we'll be back regularly, so we'll see you soon again, and there will be sandwiches and drinks outside. So thank you very much for coming.